Imagine standing at the edge of a vast ocean, planning your voyage. You would want to know about potential storms, treacherous currents, and hidden reefs, right? In the complex world of finance, assessing these unseen dangers is precisely what financial risk assessment aims to do, helping institutions and investors navigate uncertainty with greater confidence. When it comes to understanding and quantifying these financial risks, several statistical models are absolutely crucial. The primary models that apply to financial risk assessment include value at risk, conditional value at risk, and various forms of stress testing and scenario analysis. These tools provide different lenses through which to view potential losses and exposures. The why behind using these models lies in their ability to translate complex market dynamics into measurable risk metrics. Value at risk, often referred to as VAR, is perhaps the most widely recognized. It estimates the maximum potential loss that a portfolio or firm could incur over a specific time horizon, given a certain confidence level. For example, a 99% daily VAR of $1 million means there is a 1% chance the firm could lose more than $1 million in a single day. However, VAR does have a limitation. It does not tell you the magnitude of losses once that 1% threshold is breached. This is where conditional value at risk, or CVAR, steps in. Also known as expected shortfall, CVAR addresses VAR's shortcoming by calculating the expected loss given that the loss exceeds the VAR threshold. Think of it as providing a more comprehensive picture of the tail risk, which is the risk of extreme, unexpected events. For portfolios with non-normal distributions, CVAR often provides a more robust and conservative measure of risk. Beyond these, stress testing involves subjecting a portfolio to hypothetical, extreme market scenarios, such as a sudden economic downturn or a sharp interest rate hike, to see how it performs. This is less about probability and more about testing resilience against specific, severe events that might not be captured by historical data. Finance professionals leverage these models in several practical ways. Risk managers routinely use VAR for daily risk monitoring, setting trading limits, and allocating capital efficiently across different business units. CVAR is particularly valuable in portfolio optimization, helping construct portfolios that minimize expected losses during severe market conditions. Stress tests, on the other hand, are essential for regulatory compliance, internal capital adequacy assessments, and strategic planning, ensuring that institutions can withstand severe financial shocks. These models provide the analytical foundation for making informed decisions about risk appetite and capital deployment. An important insider detail to consider is the concept of model risk. This refers to the risk that a model is inherently flawed, incorrectly implemented, or misused, leading to inaccurate risk assessments. For instance, relying too heavily on historical data for VAR calculations might underestimate risk during unprecedented market events. That is why advanced practitioners often combine these statistical models with qualitative judgment and incorporate machine learning techniques to refine predictions and identify complex patterns in financial data. Regulatory bodies, like those overseeing global banks, increasingly requiring sophisticated stress testing frameworks, underscoring the real-world significance of these tools. Ultimately, mastering these statistical models is not just about crunching numbers. It is about building a more resilient and strategically sound financial operation. By understanding the nuances of VAR, CVAR, and stress testing, you empower yourself to make more informed investment decisions, navigate regulatory landscapes, and protect against unforeseen market volatility. This foundational knowledge is a critical asset for anyone looking to build a robust and impactful career in financial risk management.